Hi, I'm Harper with LifeWithLeverage, and we coach people on the infinite banking concept and how you can become your own banker. Today, we're going to talk about policy loans versus bank line of credit. Now, what do I mean by policy loans? If you don't know what that is, when you have a life insurance contract, specifically a whole life policy with a mutual insurance company, you're going to have a contractual right to borrow against your cash value. And when we do that and we use that contractual option with that mutual company, they will merely collateralize your cash value or place a lien on it, let it keep compounding uninterrupted in a tax-favored manner, and you are able to get a line of credit against that called a policy loan. It's a very favorable type of line of credit, and you really fully own, control it, and there's tons of flexibility. On the other hand, if you were to use a third party, or specifically say a bank line of credit, you are going to be a slave to that bank, and they're going to want much more of their I's dotted and T's crossed. And hey, how can you blame them? They're in the business of lending money, and they want to make sure they're protected. It's just that in the mutual insurance world, you are part owner of that mutual company, so then you get to partake in having more benefits. Now, let's go to my screen here. I have a good visual to go through. We have policy loans versus bank line of credit, okay? Now, policy loans versus bank line of credit. We got line of credit comparison. You see policy loan and bank line of credit. We are wanting it, at least in the beginning, to say no means it's good, and yes means, oh, that's something we don't want, until we get to the bottom. When you get a line of credit established, whether you're getting a line of credit with a third party against cash in a savings account, or from a home equity line of credit, or a line of credit on real estate or a different asset, there's going to be an origination process and setup fees. The bank will charge that. A policy loan will not, after you already have your policy in force. Underwriting and approval hassle. Once you have your life insurance contract, when you do go to borrow with a policy loan, you have none of that. No additional fees, bank line of credit. Of course, you're going to have more underwriting or approval hassle. And bank profit markup, what I mean, they are going to have a cost of capital. So even if they're paying you 3 or 4% in a money market and you were to loan that as collateral from the bank, they're still going to want a profit from that. And they're going to want to have another 1 or 2 point spread on top on the interest rate. In the insurance world, since you're part owner of that mutual insurance company, your policy might be earning 4 or 5% in a tax-deferred or tax-free manner if handled properly. You have a death benefit, and then you can borrow against it at 4 to mid 5% right now. We're talking about December 2025. And if the gross going tax-free within, and then you're borrowing outside simple interest only at a similar rate, you actually are winning out. Now, let's look at closing or junk fees. You're going to have that with the bank line of credit, policy loan. Besides the interest rate, no other fees. Hard credit pull, usually a bank's going to want to go the whole brick and mortar route of pulling credit, going through all this documentation and signing for personal guarantees. And life insurance policy loans do not have that. Depending on what you're collateralizing, if it's cash, this may not be the case. But if you're using an asset like real estate or a business, they're going to want an appraisal to see the value of everything. That's going to be a cost to you and more time consuming. And they may want that annually, or when you're trying to renew or extend the line of credit. With the life insurance loan, none of that's going to be needed. Then, can the loan be callable? Can they not renew or extend it? And the bank, yes, could just not renew it, not extend it. And policy loan, completely in your favor. They can never call it on you. And then the repayment schedule is completely up to you, principal and interest. Now, parlays in the next thing, the repayment schedule. Yes, there's no set repayment schedule with a policy loan with the life insurance company, although we want to treat ourselves like a bank, or we're becoming our own banker, but we get to choose how we want to go about that. And the bank line of credit usually are going to want some sort of repayment schedule or some sort of terms you're agreeing to. Personal guarantee, usually bank always wants that. And with the policy loan, you don't have that. Death benefit. Death benefit is rolled into this whole scenario with life insurance because life insurance does have coverage plus that cash value. And a bank actually is not going to have a death benefit if you just borrow from them, right? And they might love if you have insurance coverage because that helps them be able to get repaid in the event something were to happen prematurely. Guaranteed renewal extension, yes, policy loan is always going to be doing that, renewing and extending in perpetuity. And bank line of credit, no, they could really tweak that, or your assets could be in potential danger, or the business deal you're doing, or your business in general, because they could call it or not renew it. And collateral compounds, tax deferred, you're going to have your collateral compounding in a tax deferred and could be tax-free manner with the life insurance contract you have in perpetuity. Once again, if handled properly, and then your collateral that you're getting a line of credit against could be going tax deferred, say if it's in real estate, but if it's just in a money market or savings account, it would not. I have a few other things here that I wanted to factor in, because as you can see, you have the ultimate flexibility and control with a policy loan versus a third party. A bank loan is their money, their terms, okay? Policy loan, your money, your schedule. Some of these are just to sum it up to really hit the point home. Bank owns the rules, you own the policy, and partially own the mutual company, which is why you have this preferential treatment. Bank loans show up on credit report. Policy loan is invisible to the bureaus. Read that one online, thought that was really good. And of course, bank loans usually are having personal guarantees that could put your assets or your personal net worth at risk. And also your cash within your life insurance contract is typically pretty creditor protected depending on your state. All the way around, it is much more peace of mind to use policy loans to finance your lifestyle or your investments or escrow things like taxes and things of that nature. If you want to talk further, or you're like, hey, Harper, I disagree or I agree with some of this, hey, reach out to me at harper@lifewithleverage.com or go to lifewithleverage.com. Love to talk with you. Love to see if this is a good fit. Or if you have any rebuttals to what I'm saying, always open to conversations. Looking forward to talking to you. Thanks for listening.